to closing, and we're going to boil that down into 5 easy steps to follow. But before we get there, you may wonder, why do we care? Why do we care about venture capital? Why do we care about making it easier for you to launch a firm? And I want to take a minute and answer that, because we're at VC Lab transforming venture capital into a force for good in the world. And that is because we know from our experience working at and running the Founder Institute. Mike and I both were senior individuals, and I founded the Founder Institute. So Mike and I worked together there. That all around the world, there are amazing startups looking to disrupt various industries and transform those industries into things that are working for humanity rather than against humanity. So there's innovations in energy, innovations in climate, innovations in healthcare, and deep tech, and the list is long. And those innovations are not happening just in Silicon Valley or just in New York or just in London, where there's large venture capital scenes today. They're happening everywhere. And so if we believe that if you take these disrupting startups and you add smart and ethical capital everywhere in the world, that we're going to go through a period of positive global change that is desperately needed right now. And as a result, our hope is that by 2030, these initiatives all around the world will allow us to reverse climate change, which is a detriment to all living things on the planet. We'll be able to increase biodiversity versus our current path of just rampant destruction of the biosphere that supports us. And we can do all this while powered by renewables versus, digging holes in the ground and extracting oil that is really literally fossil fuels to fuel the transformation that's been happening to date, and frankly, a destructive transformation at that. So that's why we think venture capital is important. That's why we do what we do. And I want to talk with you about how you can get started in launching a venture capital firm and contributing to the solution versus contributing to the problem. So why don't we get started? Okay, so there are 5 steps to start a venture capital firm. You need to draft a compelling thesis, and I'll talk more in detail about each of these. You need to have a strong track record, and you can even create one starting right now if you don't have one at the moment. You need to create clear and compelling materials. You need to pitch hundreds of leads, and then you need to run an efficient and fast closing process. So everything starts with the thesis, okay? And we've created at VC Lab a template that captures all of the information that needs to be in your thesis, right? You have the name of your fund is launching and then the amount that you're planning to raise. So like a $5 million, and then the stage. So it could be like seed stage venture fund. Now, limited partners want to know where you are. So you could say, in my case, in Palo Alto or in Silicon Valley, to back, and they want to know what you're investing in, right? So you could say US deep tech companies, right? So you're telling them the geography where you're investing. So you're telling them where you are, the geography that you're investing in, and the focus of the market that you want to go after, or vertical or segment. And then you need to add your secret sauce. Now, your secret sauce is almost always going to be your track record. But if you don't have a track record at the moment, but you have an amazing network of unicorns, for example, you could say, because I run this community that has, 25 unicorns in it, right? But for most of you, it's going to be your track record. And we're going to talk about track record next. So I'll go into more detail about this. One of the things I want to talk about, though, that is a huge mistake I see a lot of first time and new managers make is their fund size, right? That red item there is too large. Okay. When you start out in venture capital, a fund is like a product, right? So you start a firm, a venture capital firm, and it has a fund, but it's going to have lots of funds over time. And your first fund is like a MVP, right? So it's the minimum viable product in a company, and it's really a minimum viable product fund in a venture capital firm. And so if you're doing a $50 million first fund, that is not a minimum viable fund. That's a kind of big fund for a first fund. So you really want to start with a small fund, like 5, 10, maybe 15, very maybe 20, and unlikely 25, because you want to close the fund quickly. You want to prove out all your ideas and methodology, and you want to then get on to fund 2 as quickly as possible. And if you shoot for like a $50 million fund, it could take you 12, 18, or 24 months just to get to a first close, right? Then it could take you another 24 months to finish closing it, another few years to deploy it. So it could take you like 6 years to finish fund 1, right? Deploying capital, raising it, et cetera, and then waiting on the returns. That's crazy long. That is not a minimum viable fund, right? But if you do like a $5 million fund or $10 million fund, you could be done with it in 24 to 36 months, less than half the time, right? And then on to fund 2, and fund 2 could be very large, and possibly even larger if you take the sum of fund 1 and sum of fund 2, then your $50 million fund that you wanted to try and do. And it'd be a lot easier for you to do as well. So start small with your fund size. Now, there's a lot of data. So there was a group that surveyed thousands of limited partners. And they asked, do you want to see funds focused on one stage or kind of all stages? 29% of the limited partners said, hey, I'm open with multi stage funds, but 71% were like, I prefer one stage. And you're a new manager, you're starting a new fund, you want to go after as many LPs as you can. So you want to do the 71% thing, which is why we recommend that all new managers pick one stage. And this is same with sectors. So like people want focus in the fund managers they're investing in. So 72% of the limited partners surveyed wanted them to focus on one sector, one vertical, one specialization. They didn't really, again, 18% were okay with generalists, right? But you as a new manager, going after a general thesis, we're going to fund everything. It doesn't appeal to limited partners. It maybe appeals to 18% of limited partners, but you have a hard enough time finding and pitching limited partners as a new manager. Again, you want to go after as many limited partners as possible. So you want a focus stage, focus geography, focus sector. And we have tons of experience to back this up, and that's in your thesis. And it might take you a month or 2 to get that thesis right. And that's the best time that you're going to spend on fundraising, because if you can get that thesis really good, 1 in 3 to 1 in 5 limited partners that you tell your thesis to will agree to invest. So I can't stress, don't skimp on thesis. Don't write your materials. Don't, start contacting lawyers. Just spend the time until that thesis statement is so good, and it should be roughly 35 words, that when you tell someone your thesis, you tell your bank manager, you tell a relative, 1 in 3 to 1 in 5 will say, whoa, that's pretty good. I'd like to learn more and possibly participate. Okay. And until you get to 1 in 3 and 1 in 5, your thesis just isn't good enough, and you need to stick with it. Now, as part of your thesis, as we discussed, you need to have a track record. Now, many people here have a track record. Okay, great. If you have a track record, feather in your cap, it's going to be a lot easier for you to raise. Now, if your thesis says you're going to invest in deep tech companies, and you have 100 companies that you've invested in, but only 40 of them are deep tech, you're only really supposed to say in your track record the 40 deep tech companies, because the track record must align with the thesis. All right. If your track record doesn't align with your thesis, it doesn't really count, and you need to probably say it if you're gonna cite it. So I've invested in 100 companies outside of my thesis that have a 4x return. Okay, say something like that. That's pretty good. But I think it would be, and limited partners expect, I've invested in 40 companies, within the thesis that have a 6x return. That's even better. Right? It's better because you have a larger return, and it's better because all the companies are aligned with your thesis. So you want to find a track record that aligns with your thesis. And the best way to get the track record is to have a deal warehouse. And there are different kinds of things that you can put in the deal warehouse. You can put your previous investments that are aligned with the thesis. You can put investments that you're currently doing, meaning that you're closing on right now, that align with your thesis. And you can describe some investments that you're going to do as soon as you close the fund that are also, again, aligned with your thesis. Now, if you don't have previous investments and you have some financial resources, then you can do current investments, right? So just start investing whatever money you can to build that track record right now in thesis aligned deals, and invest in deals that will have markups quickly, right? There's lots of ways. Like, we've done rounds at one price, and then a few months later done another round at a higher price. And so people who came in at the one round get a markup a few months later. Right? It's very common to see markups within weeks and months if you pick the right company. So you can make current investments right now and get markups that you can talk about, and that can sound great. Like I've invested in 6 startups related to my thesis that have a 2x markup in less than 6 months. Well, that's pretty impressive. Right? You've done 6 deals that have an average of 2x in under 6 months. Whoa, that's great. So markups are by time, right? How much time you have, and they're also by the volume. Okay, now if you don't have money and you can't do current investments, then you can look at future investments, right? So you should find a portfolio of companies that you're going to invest in, that are thesis aligned, that are exciting, and that you can talk about with limited partners and say, hey, we have 5 companies that we plan to invest when the fund closes. And you can describe them generally in your materials, and then you can describe them more specifically when you meet with the limited partners one-on-one and discuss everything. So if you don't have a track record right now, the moral of the story is you can start building a track record at any time and start building the track record right now. So thesis aligned deals with markups get limited partners really excited about your deals, about your fund, right? So always be thinking, if I don't have thesis aligned deals, I'm going to find thesis aligned deals. When I find my thesis aligned deals, I want to make sure that I can get into them or that they're going to have markups, and that gets limited partners excited. Mike, can you do me a favor and talk about this? Someone's knocking at the door. 1 sec, I got to check.
Yeah, it's super important to have thesis aligned deals for a number of reasons. So look, at the end of the day, what are you doing with this kind of first closing, first everything, right? You're essentially hacking traction, right? And so basically, initially, when you make these first deals, you're showing that the thesis that you're working on is kind of working, right? And so when you have, so it's super critical that when you make these first 2 or 3 or 4 deals that you do once you do this first closing, that they're on thesis, number one, and number two, that they get markups. Because then when you go into, say, that your second closing, your third closing, your fourth closing, whatever, now all of a sudden it's a very different value proposition, right? So number one, you're no longer a person with a deck, you're a person with the fund. So you've completely de-risked the value proposition for the future limited partners. Number two, you're essentially proving that the thesis is working because you've done these 2 or 3 deals and they've been basically marked up. So you're like, hey, this is working. And number three, you've de-risked the fund significantly because these LPs get to come into a fund that's already marked up. So it's already more valuable, right? So they're basically already getting an instant appreciation on the capital that they're kind of bringing into the fund, right? And so that's why it's so critical that you get these deals just right. If there's a correlation between folks that do successful second and third closings and folks that really struggle, it's this. It's like the deals that they've had just haven't got markups fast enough, right? And so it's harder for them to get these make the second closing a no-brainer, basically.
So normally what happens, everybody, is when you launch a venture capital firm and you launch a venture capital fund, you have fees, and those fees eat away your returns. So you have what's called a J curve. So your returns go negative when you start the fund until you start getting markups, et cetera. If you can build a good deal warehouse, you can actually have positive IRR in positive returns from day one, because you have marked up companies in your fund that you invested in or transferred in because you invested in them previously. And so within the first quarter, you can actually have positive IRR, positive returns. So, you know, we have vehicles that have positive returns because of this phenomenon, and that makes them, coming out of the gate, one of the top performing funds in the world. So this is a hack that, you know, good new managers use to outperform their peers. And here it is for you to use, you know, as you can. Okay. So after you have a strong track record that you either have, you know, used because you've been investing or created fresh, you need to build the materials because you have a thesis and a track record. Okay. And traditionally your materials consist of 5 things, right? A fund presentation, which is 15 or so pages. We'll show you the sample slides in a minute. Doesn't need to be 100 pages, very complicated. It's like, in many ways, it's easier than a pitch deck for a company. You want to have a written fund overview, like 1 or 2 pages. So it's almost like a written version of your fund presentation that is short, so that larger limited partners can circulate it so other people can read about your fund. you need to have a fund model, and there are actually tons of fund model templates out there. One of the people that works closely with us, Taylor Davidson, he has some of the best fund models out there. You can buy them. They're free if you're in the program, but you can buy a fund model for a few $100 and, you know, plug in your own variables and so that's relatively easy to do. You're going to need a data room that then has bios, references, all this material, and you know, presentations of any investments you're doing, deal memos, etc. And there, a lot of times, if you're doing a larger fund, let's say 25 million and above, you may want to have a PPM, which is a private placement memorandum. But for most funds, 25 million and below, a PPM is really not needed, because it's a CYA, or cover your ass document, produced by lawyers that outline all the risks of being in venture capital. And in, you know, big LPs will traditionally want it, but most limited partners don't need it and don't even ask for it. So we just don't recommend it unless you're going for a larger fund. In terms of the presentation itself, as I mentioned, that's about 15 slides, maybe 18 slides at the most. Here are the titles of the needed slides and some optional slides. And I want to be super clear, because I see people get creative with titles like, you know, why we're number one, you know, there's no competition, or whatever. Don't get fancy with titles. We have a data room built into some software that we provide people for free, and we can see how long people look at individual slides. Limited partners look at slides, individual, you know, slides in a deck, 30 seconds or less. Okay, so you need to have a super clear title like value add or track record or deal warehouse, so that they can say, oh, here's their track record, here's their deal warehouse, right? And then they don't have to think, right? If they're only looking at a slide for 30 seconds or less, you can't have them do a lot of processing. You can't have them do a lot of reading. It's got to be like 1 point per slide, an easy title so they can find what they're looking for and move on. And we cover this a lot more in the VC Lab program. Next on the list is you're going to have to pitch hundreds of leads. So the average venture capital firm, and you can't do general solicitation. So let me just talk about that first. You can't post on social. You can't post on LinkedIn. You have to actually work your networks, work connectors, etc., and pitch people one-on-one without spamming email, blanketing social, etc. If you see people who are doing that, they are either doing something illegal, or there's a special regulatory carve out that they're doing. But that, again, do not generally solicit. It can get you in a lot of trouble. There are different rules all around the world for this. And if you, for example, there are rules in Europe, and if you're in the US and you pitch a European person, you have to comply with both the US rules and the European rules. So basically, it's much better to be more conservative here and not generally solicit, okay? So how do you find hundreds of leads to pitch? Well, you build your network, right? So you start posting about venture capital on LinkedIn, you start posting about venture capital issues on Twitter. You don't necessarily post about your fund, but you can say, oh, wow, venture capital just broke records. And oh, wow, look, here's an interesting stat on venture capital. So you start posting about stuff. You start posting about your industry, and you just build your network. Then you probably know people who have invested in venture capital. They may be a venture capitalist and they're friends of yours, and you want to pitch them. And you can pitch your friends all day long, right? Because that's not general solicitation, especially if you're not asking them for money and you're just practicing. So and we call these individuals confidants. And you want to pitch your confidants until you get comfortable with your materials, with the thesis, with everything. And then you want to start pitching others, because, you know, it might take you weeks to get your deck in good shape. At which point you engage connectors, people that know limited partners, to find the targets in an archetype. So you might say, and we have a whole list of all these different archetypes, but an archetype could be like an athlete, or a banker, or a wealthy tech executive, or a small family office, or a founder in your space that had an exit, right? So you develop these archetypes and you start finding the people, and then find people that know them. And you want to be pitching about 20 limited partners a week, right? Because if you're gonna, like, a first close, you probably need like 100 or 200 people that you've pitched. At 20 a week, that's 10 weeks to 200, 5 weeks to 100. There'll be follow-up meetings on top of that. So this can take, you know, a couple to a few months to complete. And then as you get interest from limited partners, because it takes a long time to close, you want to get what's called we call it a pact, which is a letter of intent that they are going to invest. So you say, okay, you're interested, great. Before we go any further, can you sign something to indicate your interest that you're going to invest? And this hard circles that investor. And you don't want to begin a fund formation process until you have at least 10%, of your target fund size hard circled. And that should be a minimum of $1 million. So if you don't have $1 million hard circled, even if your fund's like 5 million, don't start. If your fund's 20 million and you don't have at least 2 million hard circled, don't start formation. Okay, so it's either the larger of these two, $1 million or 10% of your fund. You should not be talking with any lawyer, any fund back office provider, nothing. It's a waste of your time, because you don't know what you need until you have at least 10% of your fund hard circled. At that point, you'll know, oh, these type of limited partners are interested in my fund. They want me to put the fund in the US or Canada or Europe or wherever, right? And you'll be able then to make educated decisions about where to domicile, how to form, which I'll talk about right now. So you want to run generally a fast closing process once you have that 10% or $1 million, whichever is greater. So once you got it, you're like, all right, off to the races. You want to quickly secure your formation vendors, which might be a law firm, a back office provider, etc. You want to engage the limited partners that you've been talking to and get them, having them sign stuff. You want to get closing materials from the vendors, such as your limited partner agreement, your general partner agreement, your Manco agreement, and you want to read them thoroughly. And in some cases that can take weeks, because they're very complicated, very long legal documents that you just can't read in a few hours. And then you want to set up your entities. You want to end the bank accounts. You want to secure signatures from your LPs once those entities are set up. And then you want to close the fund once you have enough signatures in and start your first capital call. Now, when you set these entities up, they can be rather complicated. So you'll have at the top here in the yellow, you see a management company called a Manco oftenly that owns the brand. Then you're going to have a GP, which is the green in the middle. And that's where the carry is distributed to partners, venture partners, etc. And at the bottom is this limited partnership, which is where the LPs and often that bottom gray box is the fund. And that's where the LPs invest their money and the fund invests in startups at the bottom gray box. So this is the most common structure. And, you know, it's complicated to set these things up because each of these entities have a lot of rules, agreements, et cetera, that you need. So fund formation can take a long time if you don't manage it well. So how do we help? And then we'll open it up for questions. So we run the leading venture capital accelerator. It's 100% free. We take you through all of the steps that we just discussed in a structured process over 4 months. It looks like this. So month 1, we help you work on your thesis until it's quite good. And then we'll do a thesis review. In month 2, and we do more than that, of course, as you can see, we're going to help you work on your materials, getting everything from your deck and your other things that limited partners ask for ready. And then we're going to review your pitch. In month 3, we help you ramp up meeting limited partners and pitching limited partners. Now, we don't introduce you to limited partners, but we have systems, techniques, et cetera, so that you can develop target lists of, you know, hundreds of limited partners, and you're going to start pitching them pretty aggressively in the 3rd month and 4th month. At the end of the 3rd month, we check that you have hard circled commitments. And then going into month 4, we start working on closing. Now, interestingly enough, cohort 6, and now you would apply for cohort 9. So cohort 6 was earlier, ended at the beginning of this year. Cohort 6 has had an average close time of 5.8 months. To put things in perspective, to close on a venture capital fund as a new manager traditionally takes between 18 and 24 months. So the fact that, you know, cohort 6 is closing at under 6 months is a testament that if you follow a process and you have the right guidance, you can go from idea to close very quickly, doing something very difficult like starting a venture capital firm. And VC Lab provides the curriculum on how to do that. We provide a community and mentorship. And we have a whole free tech stack for you to use to build it on. We'll help you form the entities as well. And we'll even do a lot of the back office for you when you set them up. And the program, which is the light green stuff at the top, has an 84 net promoter score, which is world-class. And the support that we give to launch the actual vehicles has a 94 net promoter score, which is like basically unheard of. And yeah, so cohort 9, if you're interested, the deadline is November 6th. We have right now almost 1,600 people have started applications, which is a record because we just had the early admissions deadline on Sunday, and you can apply here. So let's jump over to questions.